Hi there, and welcome to week 6 of Intermediate Accounting 1. Here in our last unit, we're going to talk about some fixed asset concepts. This wraps up the course content for this quarter, for this course. Here in Unit 6, we're going to be talking about fixed assets. And again, we're taking a closer look at all the different elements and facets that relate to fixed assets and exploring them at a little deeper level than maybe what we did during survey or preliminary accounting courses. So here in Unit 6, we're talking about not only the cost of the fixed assets, but taking a closer look at the elements that relate to the cost of the fixed assets. So we're looking at what about when we have freight and sales tax and installation costs and insurances, and how do we decipher, how do we draw those lines between what gets capitalized into the fixed asset and what do we treat as a period cost or as more of an income statement item, things that we don't capitalize into the cost of that asset. We're going to take a little closer look at patents and infringements on those patents, and when we might have a conflict between two parties about those types of things, and how do we handle those situations and the payments that are made as a result of those things. We're also going to take a look at 1031 exchanges. 1031, what that stands for, as you'll see in the readings, but that's a code section from the Internal Revenue Service, and what that code section says is that if you have a gain when you exchange two like assets, a truck for a truck, a building for a building, you do a trade-in, or you trade with another party, in essence, what you're able to do is defer the gain in your acquisition of that new asset. So it's a way to incentivize people to kind of stay in the game and go from one asset to another, a rental property into a new rental property. We're able to defer the gain, and that has an impact on that new asset's basis as we move forward. But again, the like kind exchange, a 1031 exchange, that's in reference to the Internal Revenue Code section that outlines what that exchange, what it needs to have so that you can get that deferability of the gain for that preferential tax treatment. We'll also get into depreciation methods and approaches, and so again, the basic is straight line, where we're just looking at the cost of the asset, the whole cost, everything that's been capitalized into the cost of that asset. We're looking at the salvage value, and then we're looking at the life of that asset. We're also going to get into the declining balance methods, 200% declining balance, 150% declining balance, some of the year's digits, all these different approaches that we can take in calculating out what that depreciation expense is. We'll also take a little look at some impairment losses when we have to look and say, okay, this is what our book value is for this particular asset. This is what we're expecting from future cash flows. Do we have to write this asset down based on what we expect for the economic performance of that asset? We'll also get into the amortization of intangible assets, and what we're looking at there is, again, we're depreciation and amortization. Really what we're talking about, again, is that we're spreading that cost out over the life of that asset. A building is not going to have a life of a year. It's going to have a life of maybe 40 years or longer. And so what we're going to do is we're not going to isolate those costs and report them as costs in the year we buy it. We're going to spread them out over the life of that asset. So just the same is true when we look at our amortization costs, when we're looking at intangible assets and amortizing those. We're looking at a patent. How long, a pharmaceutical company that develops a new drug for whatever it might be, they have a right to produce that drug for a certain amount of time. So the cost that it took to obtain that patent, that exclusive right to produce that medicine, they're going to spread that cost out over the duration that they have to produce that medicine by themselves. And after that falls off, that's when the generic drugs come onto the market and come onto the scene. Because they're right to produce that drug based on the amount of research and development and investments that they've made into developing that drug. That's one of the examples from business that we could apply to that concept. And so again, what we're doing with all these different long-term assets or long-lived assets is we're looking at how are we going to spread that cost out over the life of that asset. That's what we're looking at with our depreciation or amortization expense. So we get underway with the discussion boards, the homework assignments, and the quiz here for Unit 6. Again, feel free to reach out to me with any questions, concerns that you may have as you get underway with the course content. Next week, we're headed into the final exam, so please do reach out to me if you have any questions at all about Unit 6 here, or as the final exam approaches next week. So thanks so much. Have a great day. Take care.